Welcome to the daily update, where I'll go over the action in the market for Monday, January 8th, and then we'll see how things look for Tuesday, January 9th. We had a pretty solid update. So far, it looks like we're bouncing off of the 20-period moving averages. That could lead to things turning back more positive. However, in the meantime, we still have a lot of our oscillators and a lot of our intermediate term indicators that are suggesting weakness is still coming into the market. But you have to start somewhere if we're going to bounce from here. It does turn out like the first 5 trading days in January were not positive. We made a good run at it, but we ended up being down over those 5 days. So now we're 0 for 2 with the trifecta. The third thing now that we're waiting for is how is the month of January going to unfold? Once that is completed, then we'll know. Are we going to have a 1 to 2 score or an 0 for 3 score going forward? But in the meantime, we did see some strength again from NVIDIA. That really helped spark up some of the growth stocks, and growth had a really good day. We're still seeing some negative divergences. There's still lots of things to worry about, but at least in Monday's session, we saw a pretty nice little bounce. So let's go back and talk about what happened. Right at the open, we had a gap higher open, and we were above the daily pivot right off the bat. So we got back above the 4,700 level, and we got above R1 at 47.18. As the day kept going, prices rose above R2 at 47.40. We didn't get up to R3, so that's not on the intraday chart. That was quite a bit above where we were at. But we ended up closing at the intraday high. And when you see a close at the high, that's usually a positive thing. We were up 1.41% on below average volume. This is a little bit of a concern. Now, we saw that in Friday's session, and now we've seen that again in Monday's session. The fact that there's not an awful lot of volume coming into the S&P on a solid up day, just something to be aware of. We are still positive when we look at all of our charts together, but we're showing some weakness. We're showing some improvement in the short term. We're no longer extreme negative in the short term. We still have a number of our intermediate term indicators that are giving us some concern right now. And it's about inflation and interest rates. And later on in the week, we're going to get CPI on Thursday and PPI on Friday. Two major inflation reports, with the big one being CPI. We're also keeping an eye on the different geopolitical events that, even though things are still happening between Russia, Ukraine, and in Israel, it doesn't seem to really be drifting into the market right now and having all that much of an impact. But that could always change if something really big happens. Some comments that we can make: we're back above 4,700, and we're 0 for 2 right now with the trifecta, tri meaning 3. So we're waiting to see what the final outcome will be with that. And then Boeing, you probably heard about over the weekend. There was a 737 that had, it's like a faux door that sometimes it's a door. This time it was a window. It just kind of flew right out of the airplane. And that kind of dragged down the Dow. The Dow ended up being negative most of the day. It closed up, but it took that push near the end of the day to really turn things more positive. So the rest of the market was doing pretty well while the Dow was lagging behind, and growth had a really strong day. We still need to see follow through with this, not just one little day here or day there, but at least in Monday's session, it looked pretty good. Saudi Arabia did come out and say that they're aiming to cut crude prices for February in all their regions because of weakening demand, and oil ended up being down. It closed at $70.92 a barrel. Here's our intermediate term list. Notice we don't have any short-term indicators right now. We're dropping over into the intermediate term extreme positive category. The ADX is still positive. The green line is still on top, but we're still above 40 with the ADX, and we usually don't get readings that high. We also have the 50-period exponential moving average. That rate of change going back 50 periods, that's still quite extreme. And then the PMO oscillators, as well as all of our oscillators, they're still extreme. They're rolling over. They're dropping below their moving averages, but they're still in extreme positive territory. We have the bullish percent index for the S&P and the NASDAQ, as well as the new high, new low study based on 10 periods for the S&P. Long term, we have the 150 period moving average steady, and we have both the simple and exponential moving averages based on 200 periods that are still extreme positive. We're still dealing with this current scenario, and I have to keep clearing my throat here, that the Fed might be done raising rates or even cut rates. It's not as optimistic right now if it's actually going to happen in March, but the market is still anticipating in 2024 that rates will be cut. But now it's back on the table that if we start seeing stronger than expected economic reports, the Fed just might come in and raise rates even more. The dollar was down and interest rates were also down, and both of those together gave support to the S&P and to stocks, and we came down to the 4% level for the 10-year yield. The 10 to the 2 and the 10 to the 3 month, those are still inverted and even becoming more inverted. We didn't change as far as sentiment is concerned. We came in at 74. We're one tick under being extreme positive, where we had been at 74 after Friday's session. Our trend is still positive, but the ADX on both the short-term and intermediate-term charts are going below their moving average. That doesn't mean a change in trend. That just means a weakening trend. Our bias is positive with the update, and I've changed our momentum from being negative back over to mixed because Monday was really a pretty solid day. The economic reports that came out were pretty light. We had consumer credit that came out. It came in showing an increase of 23.7 billion, a lot more than the 9.3 billion they had thought. Maybe Christmas ended up being a little more expensive after all. Last time it came in at 5.8 billion. And here's a chart showing that on a year-over-year basis, it still continues to decline. It's just on the month-over-month, that's where we see the increase, which is what we're seeing here on the next chart. As we come into the holiday season, at least did a couple of months ago. Here's some Isabel Net blog charts where this is just showing the U.S. job openings and then comparing it to the S&P. And we're seeing a little bit of a negative divergence here as the S&P has been going up. That's the dark blue line. And the job openings are coming down. Now, these two tend to not get very far apart from each other. They tend to move in the same direction. So what's going to give here? Are we going to see a pullback in the S&P or an increase in the job openings or a combination of the two? Also, looking at the insider transactions ratio, it's really high. We haven't seen this high reading in quite a long time. These are legal insider transactions. So like the president, CEO, officers of a company, they're coming in and buying shares in the company that they either own or work for, but they have to report that. And that's what this tries to measure. And we use this like a contrarian indicator. When we see an awful lot of buying coming in, it's like, oh boy, maybe we better shift around and look the other way for stock prices to move, or a lot of the buying may be finished right now. And we did get a latest reading on GDP, just showing that we're still positive when we look at all of the forecasts going forward. They've lowered it down a bit here based on what it was before, but we're still looking positive. The lighter gray or blue area here, that's Goldman Sachs. That's what they think is going to happen. The dark triangles, that is the consensus across different economists in the markets. And we look at ISM manufacturing, which we had that report last week, and we compare it with the forward earnings per share for the S&P. The dark blue, that's the ISM, and that's still under zero, which means it's under 50. It's showing contraction, where we're seeing the earnings per share actually show some increase. Now, they're both starting to turn back up here. For a healthier economic environment, we want to see the dark blue line eventually work its way back above the 50 level. Or is that going to mean that looking out into the future, earnings forecasts are going to have to come back down, or a combination of the two? Looking intraday, where we had a higher open, we opened above the daily pivot. We quickly went up above R1, and then we just pretty much rose. And this shows pretty solid advancement here. We got up above R2. That didn't really pose any problems. And we got up almost, well, we did hit a little bit of snag just for a second here at 47.50. That's a round number. There's probably a lot of strike prices there. And then we didn't see a lot of strength going into the close, but the last bar here did show some buying. and that meant that we closed at the intraday high. Here's the intraday 10-minute chart for the SPY, where we were positive when we opened up Sunday afternoon or evening, depending on where you're located. And then when we started the overnight session, that's when things started to go negative, but then we were able to claw our way back and work our way positive. And then we saw the nice up move, and we're not seeing things change all that much in the initial overnight session. Large cap growth versus large cap value. Even though growth had a really good day, it's still underperforming large cap value. That's a concern, but we need to see some follow through with this. We're also seeing that same thing here with our growth to value ratio. It was up and growth really outperformed, but we want to see more than just one day of this. Our end of day charts show that growth was up over 2% for the large caps and value was up 0.64%. So growth really outperformed for the large caps. It also outperformed for the mid caps and didn't outperform as much, but still did outperform for the small caps. Here's our growth to value ratio for the S&P, where we're ticking back up. You notice here that we're starting to see a death cross with this ratio. We were going down overall as the S&P was going up. That's a longer term negative divergence that we've been watching. Looking at our trend, we're coming down almost to the 40 level with our intermediate term ADX. Once we drop below that, we'll no longer be extreme. We do show a weakening trend because we're below the moving average, but the green line is on top. It's turning back up, so we still default to positive. Intermediate term, we've dropped below 40. It's no longer extreme, but it is below its moving average, and the green line also turned up. We're still seeing below average volume here. So when we look at our oscillator, it's just not getting up above the midpoint currently. Here's a look at sentiment. The Ulcer Index is kind of flattening out just a little bit. It's probably really hard to see. It spiked up last week, but now it's leveling off. When we look at the VIX with the line chart, we did decline as well as the bar chart. And that's typical of what we see on an up day where fear starts to dissipate a bit. And here's the VIX of the VIX. Also tends to go down on an up day where it's declining with the bar chart as well as the line chart. We're kind of getting close down into the lower end of this recent range that we've been in for the VIX of the VIX. We're still keeping an eye on this. When we look at the VIX to S&P 500 correlation, we're starting to break above this dashed line. We never did break above this before. Now we're starting to do that. When this really goes up, tops out, and starts to come down, that's typically a negative sign for the market in the short to intermediate term. We don't know if this has farther to go or if it's going to turn and start to come down now. The equity put call ratio, it was down. Not really a surprise on Monday after a weekend and an up day. So on the 1-day chart, we did decline, and we're also back to turning down with our 5-period simple moving average. So that's more short to intermediate term positive, especially if it can keep going. This fear gauge, which really started to go back up, did decrease on Monday, and our other fear gauge that we follow, it also decreased, but then fell back down in Monday's session. Here's one that I got from Isabel Net. This is just showing when you take the American Association of Individual Investors, the bullish percent index, the put call ratios, the active asset managers, and the VIX, you cram them all together, and we're still coming up to a really extreme positive reading now, which we tend to use as a contrarian indicator. When we look at the risk on to risk off ratio, we did tick up. We're up over 1% with this ratio, so that's showing some improvement. Longer term, we have been coming back up as stocks were going up. And then last week with the declines, we saw this coming back down. Now it's starting to go back up. Can it continue? Our advanced decline line studies, we did turn up based on price and volume, and we're well above the moving averages. We're not really seeing much here, even with the update. We're just kind of working back to territory that the market's already been in not so long ago. We're seeing where the new highs continue to trail off. We're not seeing any kind of an expansion, at least yet, for the S&P when we look at the new lows. So our 5 period's going sideways and our 10 period is continuing to decline. The advanced decline ratio did turn up, so we are positive there. Accumulation distribution almost came down to the moving average and started to turn up. This is a smart money gauge, so this is positive. The chicken money flow did go back up, but the moving average still continues to decline. It had given us a pretty extreme positive reading. Maybe it's working some of that off and can get some strength back. The cumulative NYSE advanced decline line did show an improvement, but we haven't been able to break out above this previous high. We also showed a bit of an improvement with our regular NYSE advanced decline line. This is another calculation of the NYSE advanced decline line where we also saw a bit of a tick up. The common stock, we did see some improvement just when we look at price as well as volume, but nothing too monstrous yet. When we look at our advanced decline line studies, we were up across the board with the common stock on the NYSE, the S&P, mid caps, and small caps. You can see by looking at this where the S&P is getting closer to this previous high, or the mid caps are a little further away, and the small caps are even further away. So we want to be watching that. In the short term, here's our daily chart where we came down to just about this pivot point, and then we saw a nice little bounce up off of that. So that so far is looking pretty good. On the bottom, we are still below average with volume. This is a chart that I used to show all the time, and then for some reason I stopped, and I thought I would include this again. This is from stockcharts.com. One of the folks that supply information is called Decision Point, and they've come up with this model, this trend model, and they have trend model signals and when they were generated for the short, mid, and long term. And currently they are positive across the board. The PMOs, which was developed by the person who founded decisionpoint.com, Carl Swenlin, in the short term, we're still looking negative, and that's what we're seeing on our chart. And also in the midterm, it's positive, but in the long term, it continues to be negative. And it's been negative since April of 2022. When we look at our moving average study, we are going back up with the 20, but we're not extreme. We're turning back up with the 50, and we're still extreme, and we're just barely extreme with the 200. So we're still looking overbought in the intermediate and even long term. Here's the 20-period moving average study where we came down. We closed below the simple moving average, and we came down to the exponential moving average. And if the market was going to make a line, it had to do it at this point. That's usually the short-term moving average that the market uses. If we had fallen below that, which still may end up happening, but for right now, we've been able to bounce up off of that. If we fall down below this, the next logical point would be the 50-period moving averages. The force index did shoot up and actually went more positive, but it's still below a declining midpoint. Our stochastics in the short term, after being extreme negative, have now shown some improvement, turning back up in the intermediate term, coming down still and no longer extreme in the long term. And we're bouncing up off of the midpoint with our standard deviations chart, and we're now up in the +2 standard deviation channel. And we're coming back up to the 20-period double and triple exponential moving averages. They haven't really turned back up very much yet. If we can get above this and see these lines turn back up, that would turn the shorter term trend more positive. Intermediate term, this is where we're still seeing some problems. Not so much with the balance of power. We're still above zero or above the midpoint, and we showed an advance. The go-no-go system is showing a darker shade of blue. That's more positive. We're coming back above the midpoint with our highest high, lowest low values chart. We're still declining with the TTM squeeze. It's positive because it's blue, but it's more negative because it's dark blue. And our 50-period moving average study for double and triple exponential purposes here, we were able to come back up and close above the double. We still are underneath the triple exponential moving average. We're coming back slightly positive with the ease of movement. So that's intermediate term positive. We've seen no change in the Erin indicator. We're still positive because the oscillator is above zero. And we've been able to tick back above the midpoint or the zero line for the S&P 500 McClellan oscillator. So we're starting to turn back up slightly based on price, but we're still declining based on volume when we look at the summation index. The NYSE McClellan oscillator did show some improvement, but is still below zero. So when we look at the summation index based on price and volume, we continue to decline. So we're still more negative in the broader market. The Swenlin trading oscillator turned up based on price and volume, but both are still below zero. And we're still rolling over with the PMO on top. We're crossing below this extreme reading based on price. We're declining as well based on volume. And we're still seeing this longer term negative divergence with the PMOs that are rising, but it did show some improvement. We're still declining with the buy signals and also seeing the negative divergence. We're still extreme positive with the PMOs that are above zero. We've changed over to positive for the Elder's Impulse system for the S&P. We have not switched positive for the parabolic SAR. The dots are still on top, so that is still intermediate term negative. The slope oscillator is no longer extreme and continues to decline. The MACD turned up just a little bit, but is still below its moving average. So looking at all of our oscillators, we're now still pointing down in the short term with the slope and TSI. We're also negative with the MACD, the PMO, and the PPO. We're crossing below the moving averages in the long term with the tricks and KST. We're no longer extreme with the KST. We're still extreme with the tricks. And here's another look at how we came down to the 20-period moving averages, and so far have been able to bounce up off of that. The bullish percent index, even on an up day, it continues to decline, but it's still above 70. So that's positive, but the fact that it's coming down is negative. And we also turned down and went kind of flat here with the NYSE bullish percent index, and we're still continuing to decline with the NASDAQ 100 bullish percent index, and we're still not below 70, or I should say we're still above 70. We turned back up slightly with the Sean trend meter. The Chaikin oscillator turned back up a little bit, but is still negative. The percent B indicator is gone back above the midpoint here, and we were able to get back above the midpoint for the Bollinger Bands. The money flow index is turning back more positive. We're above 50 now. The ultimate oscillator did show some improvement, but still below 50. The vortex, after crossing over negative after Friday's session, we now are barely crossing back over positive. The green line is just a little bit above the red line. The rate of change continues to just give us this astronomical reading, and it's been doing that now for a number of days. The RSI based on 14 periods, it didn't make it down to 50 and is starting to turn back up. So that's more intermediate term positive. We crossed back above 50 with the 9 period. That's more short term positive. On balance volume, did see a tick up, and we're still above an advancing moving average. Here's a newer chart. This is the NYSE advanced decline line, and that's what I'm measuring with the moving averages here. The reason I bring this up is we've seen a recent golden cross when you look at the NYSE advanced decline line, and then the black area is the S&P 500. So we're trying to look at the index itself and then the broader market measure together on this chart. This is also another new chart where we look at the new highs and new lows, and we're starting to come up. This is a 50-period moving average. I took the indicator itself off of here. And for most of 2022, we were down below this, and that was quite negative. Now we're starting to come back up and go above zero. Can we stay above that, even if we see a decline? The longer we can stay above this, the bigger picture is going to turn more positive. But when we look at the 200-period moving average study for the S&P, we did turn up, but we're really near that extreme reading. We're getting back to being extreme with our 50-period moving average study. And I tried to clean this up just a little bit. We did start a new cycle on January 2nd based on the 50-day cycle. So far, we have been declining, but then we saw the up day. This is also kind of interesting, this little mini rainbow here. We came down, and at least after Monday, it looks like we may have found some support right here, and then we're able to bounce up off of that. Our different charts, we're looking a little better with the hike in ASHI. We're still negative with the KEGI since we've turned red, but we're pointing up, so that's more of a positive slant. The Renko chart, even with the up day, when we were going down, this thing was just looking positive. Now that we have an up day, this is starting to look a little more negative. And the 3-line break is also still showing some negativity here. So we're getting some cross signals as the market tries to decide, is it going to shift more negative or shift back more positive? Our long-term charts, we're still extreme with our 150 and 200 period moving average studies. We're still above this longer-term trend line going back to the 1987 crash. And we're right about on the trend line now with the NASDAQ 100 going back to 2009. We did see a pretty good move with the equal weight index, but we saw the S&P outperforming, and we can see that a little bit here in our ratio where we were up with the ratio. That means the mega caps did outperform. We're still seeing a longer-term negative divergence with Dow theory here, where we're trying to come back up, and if we see any more advancing, we might get a new all-time high with the Dow, but we never even came back to this previous high with the transports, and that's a negative sign. Since interest rates were down, we ended up seeing utilities going up, which is not usually what ends up happening these days. The transports still continue to underperform the Dow, and that's a longer-term negative divergence. The Dow ended up being up a little over 0.5% and is so far holding up. The diamonds have switched over to positive after being neutral. The NASDAQ was able to get back above this pivot point, so that's showing some improvement. The NASDAQ 100 also broke back above this pivot point, and we've turned over from being negative with the Qs over to positive now with the Elder's Impulse system. We're still negative with our momentum. When we look at the PPO, we're turning up, but we're still below a declining moving average. The small caps showed a little bit of a spike up here. We were able to get back above this pivot point, and we're working off of a recent golden cross. We switched from being negative with the small caps over to being positive now with the Elder's Impulse system, and we're right at about this, you could call it support or resistance, depending on which way we're moving. We're just a little bit above it right now with the Russell 2000 small cap index. We crossed just a little bit above 50 with the RSI. We're still declining based on the momentum basis, but we're still generating a recent golden cross. The mid caps also were able to break back above this pivot point and also have a recent golden cross here. And the mid caps have turned over to positive with the Elder's Impulse system. The financial sector is still looking pretty good now. It's still in a pretty solid uptrend. The FANG index was up 2.75%, showing a bit of improvement after it had a weak week last week. How's that? Then the dollar ended up being down just a little bit, even though it closed slightly higher. This comes in after the market closes, so because the dollar trades more 24/6. Keeping an eye on bonds. After coming right up to the 200-day moving average with the 10-year yield, we actually declined with the 10-year yield, which means we went up based on price. And then updating some of our other charts, the Qs are improving compared to the S&P, but still under a declining moving average. The same thing is true with the discretionary to S&P and when we look at large cap growth versus large cap value. So we're seeing some improvement here, but nothing is really changed all that much yet. We're still seeing some weakness with our growth to value ratios when we look at the large caps, mid caps, and small caps, even though there was an improvement. And we're still pegged near the top with our 10-day average of the S&P 500 highs minus the lows. We're still above zero when we look at the highs minus the lows and take a 5-period moving average and then measure that against the broad market, even though it has been declining lately. And we're still turning back down with our 50-period moving average for the S&P of the highs minus the lows. And we're still coming down as far as the 2-year yield, which often gives support to the S&P, and that helped things out in Monday's session. So what's our outlook for Tuesday? Is the January effect over, or is it going to resume at some point? Then the trifecta. We're 0 for 2 so far. We still have one more score that'll come in at the end of January. The technicals are positive, but we are still seeing this weakness. We need to see more than one update. We need to see things start to change to turn more positive and really have more confidence in that stance. We are bouncing from the 20-period moving averages. We will get the trade balance. Not a really big deal, it's probably going to be negative, and so it's not a real market mover. And keeping an eye on all the different geopolitical events that may come in and have an impact. Then on Wednesday, we're going to get the mortgage applications, which is what we get every week in wholesale inventories. The big one is going to be Thursday and Friday with CPI and PPI coming out. Seasonally, we are looking fairly positive here with the Dow and the S&P neutral to positive, where the NASDAQ is just more flat out positive. We'll be on the 6th trading day of the month during an election year. We don't see a big move when we look at the green dashed line. And I switched this over to take up some of February now because we're wondering where are we in this whole thing as we're starting to work our way through January. Have we seen the move down here? But that tends to come near the latter part of January. Is this little hiccup that we've seen here? We don't really know where we're at when we compare it to the historical chart. And then when the president is running for re-election, going back to 1950, we tend to see things start off pretty choppy, and that's how this year has started. And we also see that brought out in the Stock Traders Almanac statistics. We're looking at the green dash line, which doesn't really show any major advancements. But when we have the sitting president who's running for re-election, we should be seeing more strength than what we've been seeing in 2024 so far. Tuesday ends up being a down day, not by any real big margin, but still, where the Monday Thursday and Friday tend to be positive, where Tuesday and Wednesday tend to be negative. So our scenarios can't really go with the down one. Even though we still see weakness developing, we're still looking positive with our charts, and we're bouncing from the 20-period moving averages. So if anything, we still default to that. We're still concerned about the ADX in the intermediate term because it's above 40 another day or so, and that could come below. But we are showing a weakening trend. The green line is still on top, so we default to positive. The warning signs, we're still seeing this longer term negative divergence when we compare growth to value. Risk on posture is showing longer term weakness, but it did bounce in Monday's session. And this is also longer term negative. The transports are negatively diverging from the Dow and also from the S&P. The 1 to 3 month yield in the short term, that still continues to be positive. I don't have a chart for that. I can't really seem to find an explanation for that one. The parabolic SAR chart is still negative. The Copic curve is negative. Our oscillators are rolling after being extreme positive, and they pretty much have all dropped below their moving averages now. The NASDAQ 100 PPO continues to be negative. Then when we look at the positive signs, our daily special K chart is still positive. The 5-period equity put call ratio is back to going down. That could be short to intermediate term positive. Our longer term equity put call ratio is still going down. The bullish percent index is still extreme. It's above 70 and it is coming down. The vortex is crossed back over to being positive, where if you watched the video for Monday, I switched it over to the other slide and it had crossed over negative. The Zohorchak method has not changed. The Russell, the small caps, and the mid caps have recently generated golden crosses. Small and mid cap growth is still positive, but it's pretty much chopping sideways. The financial sector is one of the brighter looking areas right now, and our new high, new low study for the S&P 500 based on 50 periods, it's ticking down a little bit, but because it's still above zero, it is positive. Our conclusion, we are positive, but weakness continues to develop. Now, another good solid update could change that, but if we start to chop sideways or even have more of a decline, that weakness could continue to grow. But as of right now, we're bouncing off of the 20-period moving averages. That's what we can say in the short term. We're still seeing some overbought conditions in the intermediate term, especially our oscillators that are extreme and rolling over below their moving averages. And we're still seeing our longer term moving averages are overbought in the long term, but we're still positive as long as we're above the 200-day simple moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.